thank you so much for joining me today,
Tendani.
A surprise for you as well?
Yes.
You were saying earlier in the break,
yes.
A surprise cut, yeah.
It's a surprise cut, meaning that the Reserve Bank is more concerned about growth than, the primary mandate, which is inflation. Admittedly, inflation is within target and is expected to remain so for longer with the new focus that the bank gave out. I think what it set out is the expectations now with the market and analysts that should growth tank down sharply in Q2, which is coming out end of August.
What's your forecast for Q2?
Well, we are at about 1.5%.
And that, of course, is far below 2.7%
yes.
in Q1.
Yeah, where it's below the 2%, the Q1 figure, and that's coming mainly from manufacturing. If the June number comes out as a contraction, as the PMI suggests, so you're going to have a sharply slowdown in growth. And if that happens, and it happens in the Q3 again, the expectation is said that the bank is going to cut again. Now, my question would be, how much room do we have to move?
Yeah. And just, building on from that, one of the journalists during MPC said, why did you not have a steeper rate cut? And Gill Marcus thought they were saying a stupid rate cut. And she said, because exactly that, it would have been stupid to have 100 basis points. Do you agree?
I agree with that. And the fact that, can the bank afford to cut more than 100 basis points in this round? I'm not talking about today, I'm talking about if this is a trend going forward, can they afford to have more than 100 basis points? Because then we're already in negative real interest rates, and that is just going to deepen that further. A part of our financing of our current account balance comes from foreign portfolio flows into the country. Now you take away part of the reason why they invest, take the risk of investing in emerging market if you cut rates further than we have currently.
But if you're looking at interest rates, on the 10-year bond sitting at what 6 points, I can't find my note now, but it's just under 7% right now. You're looking at Spain with all their problems sitting at 7%, yes. And then you're looking at Germany sitting at 2.3%. So we're still attractive.
We are still attractive. How attractive are we going to be if you cut down interest rates further?
Yeah,
the point is you can't cut 50 basis points and just stop, particularly if growth in Europe deteriorates further than what it has already, and it damages our manufacturing sector. You need to have some arsenal. So the Reserve Bank only has the interest rate as an arsenal. And they do say repeatedly that the interest rate on its own is not going to solve the growth problem. And in any case, growth is not going to turn around immediately just because of the 50 basis point cut. It's going to take time to transmit into the real economy. Now, if you cut it now, and if something worse happens in Europe, you have started depleting your arsenal.
Yeah, and you talk about the current account deficit sitting
yes.
at 5%, at almost 5% at this point in time. That means at this point in time we need 150 billion rand in inflows in order to manage that deficit, right?
So we do need capital to finance that deficit, and I'm saying if you cut down much further than where we are currently, it might be a problem to attract foreign investment, particularly with risk aversion, if the global economy continues to deteriorate the way it is currently.
As it stands right now, we've only had 50 basis point cut. How much does that help the consumer out there? Is that really going to help growth that much, or is it just a confidence booster? It's just a signal, and does it not even send concern into the market? Because Gill Marcus is very much coming out and saying she was very concerned about what's taking place globally. For consumers, definitely you cannot sneeze. Those with debts cannot sneeze at a 50 basis point cut. It does help. Is it going to stimulate growth, create jobs immediately? No, definitely not. But it's definitely a confidence booster. The consumer confidence numbers that came out suggested that consumers are not confident about their finances going forward. So that is going to go some way towards boosting that, as well as business confidence. Thank you so much for joining us today, Tendani, to unpack that decision. Tendani Mantshimuli, consumer economist at Liberty Life.